Mike here, head trader, True Trading Group, and December 3rd. Nice day. My day was kind of cut short today. I had some things to take care of, some personal things to take care of midday, so I only traded in the morning. And just made one trade, 1-for-1, nice little trade on AETI. Good way to start the day, good way to start the week. Today's lesson is twofold. Two lessons on the same trade. One, really, guys, the importance of a game plan, a trade game plan, the importance of putting the work in pre-market. Because had I not put the work in pre-market and had a game plan on AETI, I probably would not have made this trade. So that is a very important piece of this lesson. And then also, a lesson that was sparked by a question by one of our members today in our end of day recap. I go over an end of day recap every day, review all my trades. And it really talks to the reason why win probability and like high percentage patterns is more important or should come first before risk reward ratio. And that may sound a little conjumbled together or a little confusing, but believe me, it'll be much more clear once I get into it, and I'll explain to you guys exactly what I mean by that and what I mean when I say that. I am a very firm believer in risk reward ratio. Okay, I believe every trade it should at least be a 1 to 2, meaning like if you're risking 5%, you better be making 10% or more to the upside if you're right. So I'm not saying that that's not important. It is vital. It's crucial. You shouldn't place a trade that has a 1-to-1 risk reward ratio. You just shouldn't do it. But in identifying setups and really trying to figure out the best position to put yourself in as a trader, okay, win probability on the pattern comes first. You have to identify high probability patterns that work out more often than they don't. You have to identify that first. Once you do that, it's now your job as a trader to put yourself in a position that has good risk reward. And once you've identified a high percentage pattern, okay, now it's time to focus on your game plan, your execution on that trade. And where's your entry, where's your stop loss, where's your potential profit targets, how are you going to go about executing this trade? That comes second. And I'll get into that question that member asked, specifically what prompted that discussion after market, because it's a good one. It's a topic that not many people discuss, but I feel it's important in trade selection and helping you pull the trigger and when to decide to let a trade go. All right. So before I get into that, let's talk about my actual trade itself on AETI. And to do that, we've got to go out to the daily chart. Okay, we got to the daily chart. We were gapping up above $1. And above the 200-day moving average. 200-day moving average is that purple line you see on my screen, and we were gapping above that area to start the day. Okay, I'm looking for that 200-day moving average to hold support, which currently sits at 94 cents. I said 95 to $1 area. The reason why I said that pre-market, guys, was because $1 is just a psychological level. Stocks that trade below $1 typically kind of find a little bit of resistance once they get to that dollar mark, and when they gap over $1, it's a psychological level for that dollar level to hold. Just like stocks that are trading, in the 90s, $100 level is an area of significance and a psychological level. Okay, so when we were gapping above this 200-day and gapping above $1. I said pre-market, okay, guys, my game plan here is AETI was my main focus off the bell. I like the action that we were getting going into the open. Increasing volume, was pushing to new highs. I said, watch for a pullback. I'm looking for 95 to $1 to hold support. That's what we talked about pre-market. And then I said, and then we can look for a push up towards like 175 was actually where I thought we had a chance to get to. That's because of these previous tails that you see back here. I thought we were going to have a chance to get up to there. We didn't quite get that high, though, here today. So let's get to now the intraday chart. Now that you know my game plan is 95 to $1 to hold support, break it down intraday here, guys, on a 3-minute chart. We open up, and we immediately pull right in. Open up, put in a high of $1.23, and pull right into 98 cents. 98 cents, then hold support. Your low of the day is exactly 98 cents. Right dead smack in the middle of that 95 to $1 area that I was talking about holding as support pre-market. That was part of my game plan. You know what? There's actually 3 lessons in this video because now what I'm going to talk to you about kind of talks about support and strong support versus weak support. So this is actually a pretty cool video. You're going to get a lot of lessons on this video. So going back to this AETI now, you see we pull in, okay, right to 98 cents. 98 cents is the low of the day. And the stock immediately goes from 98 cents all the way back up to $1.21. That's over a 20% bounce off of that support area. Okay. As soon as we bounce back off that level, that is showing me that there's strong support at that level that I was expecting pre-market. Okay. Strong support, you can identify when a stock pulls itself in, touches that support level, and very quickly gets off that level and very quickly shoots away from that support level, because you have to understand what's going on at a support level, why the support level is holding. And this is the difference between strong support and weak support. Strong support holds because there's aggressive buying that steps in front of that support level, and that's what pushes the stock higher off that support level quickly because everyone's rushing in front of that level to buy it. Weak support happens when there's not aggressive buying stepping in front of that support level. Okay, when there's just the selling pressure has just slowed down, and that's why the stock is holding. Like if AETI just did this, okay, this would not be an example of strong support. Okay, this would be weak support because the share price isn't moving off of the support level, but it's also not breaking it. And that's the difference between aggressive buying and passive selling. That's the difference between strong support and weak support. So once I saw we went right from 98 cents straight up to retest the high of the day, I said, okay, there's aggressive buying pressure that stepped in front of that level. That's exactly where I was looking for support to kick in. Had I not put the work in pre-market and developed that game plan, I probably don't make this trade. That's why developing a game plan and putting the work in pre-market is so important, because it gives you the confidence to pull the trigger. Okay, I didn't have a lot of time to pull the trigger on this trade. Okay, minutes to make this decision. And if I had to go through my analysis and analyze this trade while it was happening for the very first time, I probably am not quick enough. But because I already did the analysis pre-market and had a very clear game plan, 95 to $1, want to look for support to be there. So when the market opens up, I'm looking for clues of support at that level. And that clue was we pulled in right to the low of the day of 98, and as soon as we put in the low of the day at 98, we shot right back up to test the initial morning high. That's telling me there's strong support there, over a 20% bounce off that level. So right when that happened, I went, here's a tier 1 entry right here, guys, at $1.14 as we broke through VWAP, put in that little tail there at $1.21, and then pulled back in front of VWAP, got long a tier 1 at $1.14. Didn't want to get a full position here because your stop loss, you have to get it back to the low of the day. And full position from $1.14 down to below 98 is a little bit too much risk that I was comfortable taking. So I'll take you guys to my trade announcement. Here you guys can see at 9:42 a.m., long tier 1 AETI to $1.14, stop loss 96, just below that low. We'll add tier 2 through that $1.20 area because when we popped up, we put in $1.21. We pulled back into VWAP. It held. I got in tier 1 at $1.14 and was looking for another push higher, and I was going to add through the high of the day. That's exactly what happened. Okay, added right through the high of the day. Okay, and we shot right through there. I took some off right here at $1.31. Back to my trade announcements. Okay, took some profit at $1.31 as we broke through the high of the day. And then right here at 9:45, here you guys can see how quick this trade happened. Okay, that's what I mean. How I didn't have a lot of time to make this. Look how fast this stock moved from 9:42. 3 minutes later, the stock went from $1.14 to $1.39. Okay, so once I took that profit, $1.31, we pushed a little bit higher. I did not want to take more profit at $1.39, but the stock halted at $1.39, and once I saw that it was going to halt, I decided to drop some more of that position. Guys, you can tell a stock's going to halt by looking at level 2. Level 2, you'll see, 10 different market makers all come up to the exact same price, and all of a sudden you just see a ton of order flow going through at that exact price. Okay, and that's when you can tell that a stock is about to halt. You usually have about maybe 30 seconds or so before once you start to see that action until it actually halts. Sometimes a little bit less, but still enough time to make a decision and place an order. Um, so bulk of the position gone there at $1.39, and then I sold out the last piece at $1.15. Once trading resumed, the stock pulled back in, and I got flat there at $1.15. So you can see here, once trading resumed, we pulled back in. We halted here again, and then I got rid of the final piece of my position right here. I was hoping once trading resumed, we were going to push up and get up towards that 170 area. That's what I was holding on to that last piece for, but we didn't quite get there. All right, so two things we already covered: strong support versus weak support, and the importance of a game plan. Because guys, if I had to make that do that analysis in real time, I probably do not enter this trade right here, and I probably miss out on this action up there all the way up to the stock put in a high 153. Okay, so I probably would have missed that had I not done that analysis pre-market. Okay, now this takes me on to our third lesson, which talks about win rate, like win percentage and win probability versus risk reward. And it's because a member had asked me when the stock was pulling back in after that haul, pulling back in down to test the low of the day again, before the stock put in this double bottom and then ended up bouncing back, and that could have been a really nice trade. Someone asked me, Mike, are you getting long again right here? We're back down to that dollar area. You getting long there again? And I said no. And the reason is win probability, guys, and putting yourself in the best possible situations as you possibly can. Okay, that to me is not a strong setup. I'm not going to just put a bid there at $1 expecting a double bottom to form. I read this as this was the stock showing me some weakness as it was pulling in that entire move after the halt to the downside and then continued lower. I'm not reading that as a strong setup, as a strong stock. Okay, so when you're looking at the chances of that double bottom sticking, yes, in this case, it worked. Okay, but I'd say if I showed you 100 different times that a stock breaks through highs like that, gets halted on the way down, continues lower, goes down to the low of the day, maybe the stock double bottoms there 35% of the time, 40% of the time. Versus show me a stock where we break through the initial morning high, volume's increasing where you want it to, pulls back in, that initial high holds support, maybe VWAP and the 38.2 Fibonacci level all converge at that same level at the initial morning high, creating a support level. Show me that set up 100 times. Maybe it works 60% of the time, 65% of the time. So it's more important that you find high percentage patterns rather than just put yourself in a good risk reward scenario. Because yes, sure, getting long here at $1, risking to 97 cents, 95 cents is great risk reward. Okay, the stock went all the way up to $1.45. Excellent risk reward, amazing risk reward. And yes, in this situation, it would have worked out. But that is not a high probability pattern. Yeah, sure, it'll work sometimes. Okay, but out of 100 trades, this probably fails and breaks through the low of the day like this more often than it sticks and rallies back. And that's why I said I'm not just going to enter the trade right here at the low. I'd rather see this low get put in. Show me the double bottom, okay? And then stock gets back above VWAP. You got a trade line VWAP crossover right here. And then you can see the trade line started to act as an area of support as the stock pushed back up to 147. I would have rather entered this trade somewhere in here looking for that trade line VWAP crossover like $1.20, $1.21 and sell this up at $1.40, $1.45 than fish out this double bottom and then try to catch this whole move. So yes, you're sacrificing a poorer entry. Obviously, $1 is a better entry than $1.20 in this scenario. But entering at $1.20 puts you in a much higher win probability setup with still good risk reward than trying to fish out that double bottom does. So you're sacrificing a better entry for a higher percentage win rate and better probability of the trade working out in your favor. And as a trader, I feel that and guys, this is just my opinion. Okay, this is my analysis. This is how I go about my trading. This is how I decide what stocks I'm going to go after and which ones I'm going to let go. Okay, it doesn't necessarily mean that I'm always right. Now, I think it's more important to first identify a high percentage pattern, a setup and a chart pattern that more often than not, more than 50% of the time is going to work out in your favor. That's first. Then you worry about risk reward. Not saying forget about risk reward. You can't place a trade that has a 1-for-1 risk reward ratio. It doesn't make sense. Make sure you've got, a 1.5 to 1, a 2 to 1. Okay, 3 to 1 if you can find it. That's when you want to place the trade. It's up to you to identify where's your entry, your stop loss, your profit targets, and figure out that risk reward ratio. But first, make sure you're going after a high percentage pattern. And that's why I opted not to just buy this dollar area pullback. When the member asked me, as the stock was pulling back in, they said, Mike, are you getting long in front of that dollar area again? In front of 98 cents? I said, no, I'm not. I'm going to wait and see, does that area hold? And then by this time, by the time the stock it actually held and we started to get into 10:30, 10:45, I had to jump in the shower, had to get ready, and had to go head out somewhere to take care of something in the middle of the day. So I ended up not placing the trade. But a lot of our members caught this trade and got long right in this area from like 10:20 to 10:30 and caught this little move here up towards 145, 147. Okay, and that's a higher percentage or higher probability setup, in my opinion, than trying to just expect a double bottom there to hold. Okay, so a lot to cover here in this video. Go back, rewatch it again. Shoot me a comment, give me a like, ask me some questions. I'll respond to all of them. And tomorrow's TGG Tuesday, guys. The chat's open free for everyone. So go to truetradinggroup.com, upper right-hand corner, register for TGG Tuesday. It's free. Come trade with me live. Say what's up. See my screen. Hear me on the mic in real time as we go about and navigate the markets. All right? I'll see you guys in chat tomorrow. Take care.